Hello, I'm Angeline One and welcome to Beat the Street, the show that gives you all the tradable news and data you need ahead of the Wall Street Open. Coming up, jobs on deck, new year, same risks. Investors eye the NFPs for rate cut timing clues. And chips sliding at the moment. Intel, Qualcomm, Micron also slipping ahead of the cash open. We'll find out why in just a moment. And energy on the spot as well. Oil prices in focus amid Fed comments on inflation and ahead of Blinken's visit to the Middle East. Now, a very good afternoon to you and welcome to this new edition of Beat the Street. Not long now before Wall Street starts trading, and we're just getting those figures come through. Non-farm payrolls for December, we were looking at 170,000. What we actually got was hotter than expected, 216,000. Private payrolls also stronger than expected at 164K. We were looking at for 130K. Unemployment rate pretty much in line with expectations, slightly lower, but ever so slightly. We were looking out for 3.8% and we got 3.7%. Not much of a move yet. Perhaps the volatility index, just bringing that up for you, ticking just a tad higher, but not by much. Let's have a look at Wall Street as well, which is what mirrors the Dow Jones Industrials on the IG platform. And prior to this figure, we had 37,375. It has come off slightly from there. Let's join my guest, Joachim Clement from Libren right now to find out his early reaction to those numbers. Joachim, thank you so much for joining us. What do you make of these figures early on?
Yeah, if you just look at the non-farm payroll numbers, they are incredibly strong, confirming once again the picture that the US economy is running really, really hot. No signs of a recession, very few signs of a slowdown in the job market at the moment. We thought that the November data with 199,000 non-farm payroll job openings was already a very strong number and artificially increased by government workers going back to work. To have 216,000 now, even though the last month's number was revised down to 173, just means that there is absolutely no decline whatsoever in terms of job creation. That is really kind of a problem also for the Fed, I would say, because obviously we had on Wednesday the Fed minutes that already took a little bit the enthusiasm out of markets in terms of early rate cuts. And I think with these job numbers, a March rate cut is probably completely off the table, and markets will have to price later rate cuts.
Now, do you think next week's number, the CPI number, will also allude to the fact that perhaps the Fed might have to dial back these expectations and the timing of its rate cuts?
I think so, because while core inflation is slowing down and will likely continue to drop next week, the decline is slowing down as well. So it's kind of, the problem is to get this last mile from 3% down to 2%. That's going to be a very, very hard slog. And in fact, if you look at consensus expectations at the moment, we would expect that the headline number will indeed increase a little bit next week compared to the previous month, just like it has increased in Europe this week and earlier today. And that is just an effect of energy prices kind of not being supported that much as in terms of household prices for energy as they did last year. So effectively, you have base effects that artificially inflate energy inflation year on year, and that's why the headline inflation is likely to go up. But in the end, we end up with the same number. We have a strong job market. We've got headline inflation creeping up, core inflation coming down, but at a slower rate. That's not an environment where the Fed can afford to start cutting rates.
Well, what an exciting start to some action in the first month of the year. We've also got a really active week coming up. What do you think is going to move markets most on your radar?
So clearly the US inflation print is the number one thing to look out for next Thursday. That plus, I would say, in China, Chinese trade data on Friday will give us two insights. On the one hand, it will give us on the import data an insight if the Chinese economy is indeed stabilizing. We've seen some tentative signs of the economy definitely not getting worse, but we also see hopefully some more signs of the economy improving a little bit. And the export data from China will give us an idea of what demand there is from Europe and the US for Chinese goods. And that will likely give us more indication that Europe will likely be in recession in the first half of this year, while the US seems to be going strong. for now. So on the macro front, those are the two numbers that I would look forward to. On Thursday, the inflation data; on Friday, the Chinese trade data. And then again on Friday, we start the US earnings seasons with the four major banks all starting to report. And obviously, because this is Q1, this is the most important earnings season of the year where we see full year results. And we start off obviously with JP Morgan, Citi, Bank of America. Those are the guys that will set the tone as they always do. We do expect them to present relatively good numbers given the strong equity markets and bond markets in Q4 and the continued high interest rates. So banking profits should be really, really high, as well as trading profits, which should have improved compared to Q3.
Thanks very much, Joachim. Have a really good weekend, and we'll see you next week when it's jam-packed with all those events. Moving swiftly on, we've got quite a few big movers on the platform and also on pre-market elsewhere. Just checking on the ones that you can trade all sessions on the IG platform. Microsoft, one of them. Just checking in on the hourly chart because it is starting to head lower. But if I show you the day view, Microsoft all sessions currently heading slightly lower there, as you can see, down about 0.3%. The other one that we're also keeping an eye on for you is Apple. Another all sessions also lower there, tracking lower, 0.75%. And last but not least, Alphabet, also all sessions also moving lower. These mega caps are very rate sensitive, and any dialing back of rate cut expectations likely to pull these stocks down. Among the other early movers, Tesla, also one that's all sessions and very much traded by IG clients. Tesla is shedding 1.3% on all sessions. The electric car maker conducting a recall of 1.6 million, that's right, 1.6 million vehicles in China, according to the market regulator. All this comes in a time when Tesla's share price has been tracking slightly lower, as you can see there. On a day basis, it's down 5 to 6 sessions. If today it drops another 6 sessions in a row, but it has to be said that its shares have really soared in 2023. It is, though, coming up against fierce competition now as more and more other EV makers like BYD start coming online into the market in a big way. Now, back to the markets. One of the ones that we are watching very closely is Japan's Nikkei, because we have been watching what's been happening in terms of the yen too, and whether or not there were some concerns about intervention sometime in Q4 last year, but that seems to have gone away. But the Nikkei has taken the interest of our chief market analyst, Chris Beecham, and he's here to tell us why.
Continued weakening of the yen against the dollar has given some space for the Nikkei to begin to claw its way higher after a mixed finish to the year, really. While other indices continue to soar into the end of the year, the Nikkei 225, Japan's main index, really came under quite a bit of pressure. I think not reversing its gains, but not matching the gains seen particularly in the US and even European indices too. So if we see further perhaps strengthening the dollar in the wake of this afternoon's payrolls report, I think it's worth looking at maybe seeing the Nikkei pushing back towards that 34,000 level that marked the peak last year, which it saw in June, which it has yet to surpass.
Thanks very much, Chris Beecham there. And just a quick check before we go ahead of that Wall Street cash open. Just checking in on the Wall Street index for you on the IG platform. And it is coming off slightly, futures on other markets, but here on IG, you can see that in real time, extending losses after those stronger than expected US jobs numbers, in all cases pointing and signaling that the US jobs market continues to be robust, and this could perhaps dial back those rate cut expectations from March, which is when the first cut is expected. Well, that's it for this edition of Beat the Street, and more next week when we've got retail sales figures, a CPI number, and also, of course, the start of the US earnings season with the big banks reporting at the end of the coming week. Until then, you can find further analysis on @IGCom or @Angeline Ong on Twitter. This is IGTV.